We're back in the cycle where bad economic news is good news for markets because a weak economy means fewer rate hikes, or so traders hope. Overnight, America released figures showing its economy shrank 0.9% in the June quarter, way worse than the 0.4% growth expected. It's the second straight quarter of economic contraction, which meets the technical definition of a recession. But in the US, it's not a recession until the Bureau of Economic Research deems it so. And even if the US is in a recession, technical or not, it's a pretty weird one, with unemployment just a smidge off its record low at 3.6%, and no discernible slowdown in activity yet, with the amount of goods trucking around the country back at heady pre-pandemic levels. So overnight, US markets saw some pretty good gains. Wall Street was already buoyant from the night before, when the central bank boss said while hiking rates that at some point rate hikes will slow down. So the S&P 500 just notched up a record two-day post-Fed meeting rally. It is still 16% down from the peak though. The local market had a buoyant day itself. Hints of stimulus from Beijing saw iron ore prices and therefore resource stocks and the Aussie dollar bounce. Earlier in the week, we had consumer inflation. Today, it was business inflation data. It's up 5.6% for the year. It's pretty extraordinary price hikes across the economy, but particularly in construction. Here's input prices for home building up 17% in the last year, just as Australians embarked on their biggest ever building bonanza. Great timing. That's finance.